Okay, folks, welcome to another FOMC statement and presser. We are 21st of September 2022, and for you guys, the room is pretty packed at the moment, so nice to see the guys in ready for this. All right, so we're going to get into this. We're not going to waste any time. We got 8 minutes until the statement. All right, so essentially, what we're looking at for this one is the expectation is a hike of 75 basis points. What is not priced in here is a 1% hike. All right, and so we're looking at end of year projections about 3 to 3.25 on the rate for the end of the year. Essentially, the markets are looking at 150 basis point hikes between now and across this meeting and the next meeting in November. Okay, so we're set up for really a clean 75 this meeting, 75 the next meeting. If they're going to go for a 1% clean hike on this meeting, then they're kind of setting themselves up. Now, they're not stuck to only 150 basis point hikes across this and the next meeting, but if they did want to take that sort of pattern, doing 1% on this means that they're kind of then saying they're going to slacken off a little bit on the next meeting of 50 basis point hikes, which I don't think they're going to do. I think they're going to do 75. Now that's what's priced in. Okay, so how do in the lead up last week? All right, we had been drifting bid up. Now I'm showing you the dollar, and I'll come back to the dollar, but to illustrate, the fall from grace that we had in these markets. Essentially, I've got a spooze on the 1 hour just to really show you what got overly priced in here, which was a soft August CPIs. And you see this just bid, comes in, hot CPIs, steaming hot CPIs, down we go, bang. And we are pretty much down to test this sort of trend channel on the spooze right now. So I'll just jump over. We did cover this, I think, in the pre-US this morning. We did cover this, but however, here's weekly bars on the spooze. Look at the COVID low here. Look at the June low. All right, June low. What was the low of yesterday? Bang on that trend. Now we're sitting here on the edge of cheap prices, pretty much. Is it going to get cheaper, or are we going to rotate back up within this sort of compression pennant that we have here? Right, this very technical view. We're pretty much highs of the week so far are the highs of the week of the 16th of Feb 21. All right, that's just technically where we're at. My hunch is that they do 75 basis point hike tonight, and we bid back up and compress here. Okay, that's my thesis. Am I going to be trading that? I'm going to trade what I see, like all of us do. I'm not going to trade some big old thesis, right? But that's a hunch of mine. All right, 5 minutes to go. All right, let's look at the Dixie, okay? Because essentially what we're going to be looking at across this will be, you're looking at dollarized risk here. So, for all the FX traders, this is like Super Bowl night, okay? You want to, because if you're trading, Kiwi dollar, if you're trading cable, euro dollar, peso dollar, that's actually a tricky trade, the peso dollar on these events. But it's not that tricky when you just got an uber strong dollar. Any of those pairs, this, you're going to get some serious dollar moves on this, especially if it comes out at a 1% hike. I don't think that's really priced in. I think maybe 20 or 30% of that might be priced into the market right now. So what does that look like? Okay, so we'll start off with the dollar. 4 minutes to go now, and we'll then go live with the guys in News Squawk. So, essentially here we are, weekly bars. All right, we're working up this pretty steep linear regression channel in the dollar, straight up through those 2017 highs. Back up here, keeps going. I think we're pretty hot on this dollar. If it's a percent hike, I think we're going higher. We're probably going to go to 112s actually. Now, some people might call me crazy for saying that, but I don't think too many will, given this dollar is insane. So if it's 75 basis point hike, I think we're going to come back on VWAP, and I think we're going to go lower. I think we're going to go a lot lower because it's priced in, and there's a lot of risk priced into this dollar albeit it has come true on the hot CPIs, and that's why we are so inflated right now. So look, if we come in 75 basis points cut, I think we can go up in the euro, or sorry, in the SPOs. I think it's going to be interesting I think the better moves are actually going to come when we get to the presser. If it's a 75 hike, and then we get to the presser, I think a 75 hike, I think we'll stay buoyant on equities, and then we'll get to the presser. We might get some uber hawkish language, talking about the hot CPIs and the PCEs, which is, of course, the PCEs, the preferred index and data point for the Fed. All right. So just got pretty much 2.5 minutes now coming in. I hope everyone's doing well in YouTube land. Boys in the room, managing to stay out of trouble today. Amir, Baggers, Bernie, Chris, Hollywood, Ian, Luca, Parwiz, Rob, Steve, Taskmaster, all eagerly awaiting this statement. Test here. Okay, Squawk is live. Gonna have the VIX up here on this as well. Top right of your screen. So we've been looking at the VIX. Now on the VIX, positioning on equities here, really big trend area here for the supports to come in. So we talked about 2675s, maybe not big supports, and that's coming through right now. 2645s, probably the same. Big support though is kind of this trend channel here, 26 coming in at 2620s. I think on a 75 hike, we come down here. I think on a 1%.
1 minute now to the FOMC and dot plot. As a reminder on the Squawk, I'll lead with the size of the hike increment with 75 basis points expected, then go into the dot plot before going through the accompanying statement.
I think at a 1% hike, we are going sky high on this VIX, and I don't even know if I'm going to catch that trade.
Ten seconds. $75 basis points as expected. Do the Fed median view of 2022 and 4.4%, 2023 4.6%, 2024 rate seen at 3.9%, and initial 25 at 2.9%. So that terminal rate 23 now seen at 4.6%. Coming into the statement, it says inflation remains elevated, reflecting pandemic-related imbalances, higher food and energy prices and border price pressures. War in Ukraine creating additional upward pressure on inflation, weighing on global activity. The Fed says it's prepared to adjust policy as appropriate. Says vote in favor of policy was unanimous.
All right, we're back on the QP val here, boys, where we were yesterday, finding late supports. What is it? 38.68. It's pretty messy so far. I think we're going further down here. So off to the races to the downside. Dollar up, VIX up to ETO now, just below ETO. Dow, everything kind of breaking. Dow, the first to break on this kind of morning trend.
Fed officials see PCE inflation at 5.4% this year, up from 5.2, 2.8 next year from 2.6, and 2.3 in 24 from 2.2 prior, with the initial 25 inflation forecast seen at 2%. Do note the longer run Fed median dot views seen maintained at 2.5%.
Let's launch it.
Just looking at the GDP forecast, Fed officials now see 2022 at 0.2%, down from the prior 1.7%, with 2023 downgraded to 1.2 from 1.7%, and 24 seen at 1.7 down from 1.9. 2025 initially seen at 1.8%, with the long run GDP growth dot at 1.8% unchanged. Unemployment seen at 3.8% this year, up from 3.7, 4.4% in 23 unemployment rate, up from the prior 3.9, 4.4 in 24, up from the prior 4.1, and 4.3% in 2025. The long run unemployment rate forecasts remain unchanged at 4%.
All right, we're going to leave it there from the squawk, and thank you very much to the guys for that new squawk. So look, at 75, the market really not actually that bad right now. I mean, we're pretty much just negative 0.4 on Nasdaq, 0.3 SPOOs, same on Dow. Dollar is not going to stop there, I fear. Seeing it in the euro now, same way we have this channel on the euro, on the dollar, we have this channel down on the euro, as you would expect, right? Just trading into the middle here on that channel. Oh, the euro, seeing just rising there from that trend point. Okay. Quite an important area. Now you're seeing SPOOs coming down to this mega trend, all right? We're breaking that said type of trend on the Nasdaq. Now we did break that yesterday, just a smidge, all right, and the day before. Coming down on the euro now, this is really a lot of pressure. For the dollar, for the Dow, it's not even able to get back up into here. So it's quite telling that we're pressing now on some significant levels on the Dow. This is actually that's the weekly bar. Yeah, I mean, we could probably just adjust that back up to the low that week of the 16th of May there. We are off down to the downside here. Yeah, I think, there you go. The VIX crushing up through the ETO. And this is really, if I blow this up on the VIX now on a sort of a weekly bar, you can kind of see this really set to, let me adjust this to the trend channel. Yeah, I mean, the next stop up on the VIX here is going to be like 28 halves, 28.55. That's the only place where we have really key resistance on this thing, right? So it's way up there. See, I don't see this VIX continuing to crush at that rate all the way up until we get the statement, in the presser. But we'll see. See our excess there on the lows on the SPOOs. Very, very, very tricky trading conditions here. All right. The DAX of all things currently testing VWAP, ETH VWAP. Running back down to the lows here on Dow and SPOOs. All right, so about 23 odd minutes now until we get the statement from Jerome. Yeah, so the terminal right now 4.6 in 2023. Expecting 4.1. So that's kind of probably the more hawkish downside catalyst here, you know. Okay, probing into the S1 on the Dow and the SPOOs and NASDAQ. Can't hold it. Can't hold it down there. This cannot be done. Probably going to need to have some fresh legs to sell this. There we go. Nice big lift back up there on P-Val on SPOOs now. Trades. We're up above that now. Bit of drive into the upside. Took a little bit of Dow on this. Scalper City here. Might want to try and run some of this though if you are on the longs. We are very far from average pricing. On T1's Dow 37.56. P-Val is 770s there. And the big question for me is how much of this dollar wants to price in that rising expectations on the terminal right there. 4.6 in 2023. Just to remind you on the S&P what this looks like on a bigger chart, right? And there you go. Look, just on the top right, the VIX down below this 27.15s, which was sort of a target for us to look at. Very big resistance for this market on the VIX this week. All right, this is what it looks like on the SPOOs. We're still not, cutting below this trend, right? Still not really there. Nice little rattle on the level there, but it just hasn't got the stones to do it today. Right now, I should say. So Okay, so breaking down on equities. I think this is really healthy, to be honest. We just, get this bear trend underway again. And oil, look at oil here, new lows on day. Oil lifting off of the lows here. Just a little brief runner indicator that the dollar may be softening in a material way. 10 minutes until the conference. Yeah, I mean, like oil is just so screwed down here. It kind of feels like we just need to get, as soon as we can get to 78s, 77s on oil, the better. Kind of just feels like that. Looking at oil, that kind of 78, 77s, the 2015 high. And this is kind of where we were sitting, 78, 77s back adjusted was where we were sitting right before the invasion of Ukraine. So, I mean, we are you can see we're selling off of the invasion top there. 89.66 is back adjusted on the November contract, which is what we're trading as front month right now. So if you're trading different kind of handles, like different products, right? So, if your symbol isn't CLX22s and maybe you're trading CFDs, God forbid, or you're trading, spot, really, you can match up the candles. The easiest thing to do is to just match up the candles as opposed to trying to, figure out what the adjusted price is, if it's different to what I have. Match up the candles. Like these are 60-minute candles here. These are weekly candles here, and that accounts for all of the products, essentially. Yeah, see, now the VIX is stalling out on the ETO. Quite happy I was taken out of that short on the spoos because be nothing but horseshit holding on to it now, really. Generally, I think we gotta wait for the presser to get a nice, clean, bigger sort of trade. $38. That's par whiz. That's pretty much exactly where I got out. Yeah, sitting right there now. Do I want to get back in? Yeah. Well, no. No. What, have my risk over the high of day? Yeah, right. Sounds like something FX King Pro would do. What a legend. Shout out to FX King if you're listening out there. Yeah, so we just have this, sort of murky limp into the presser, as always. But I tell you, it's a fast 30 minutes, really. I think gold went down there, S1. I mean, looking at gold on the broader shape of things, just it's like a bad girlfriend. Really, it's like a toxic relationship. The relationship I have with gold now. I mean, I just can't quit it. But now that we've broken this area, look, I was buyer here. I think a few of us were buyer here down in the 17s, and we got a nice spin out of that. I mean, it cut just before the 18s. A really nice spin. I did have high hopes that we just have a mini bull back onto the 2017 26s and then keep going. No such luck. No such luck. It is officially a toxic trade. Do I want to short it? I don't even want to bloody short the thing. No, just please, no. No more. All right, here we go. Spoos coming back on PVAL, or yeah, PVAL. I mean, you could say that the VIX has completely died down, but yeah, in the context of we're waiting for the big daddy with the printer now to come out and move these markets a little more. Nice offs to be had on the DAX over here in Europe, by the way. Buying VWAP has been an absolute delight here. Pretty much just one excess low test and then back up she goes. Fucking gold, excuse my language. All right, DAX. It's like the inadvertent trade in a way. Same way. I mean, I don't like to do it or condone it, trading U.S. equities, in the morning time, like European morning. But I think very much, because these U.S. equities are driving the picture. I think this is just a bit too cheap for the DAX this morning. Or sorry, right now, and then quite an easy layup trade. Bang, down to average pricing, up she goes, taking 2 to 1s on that, easy peasy right now. And I'll run this hopefully to back up. Let's see how these markets take Jerome though. Probably not going to take a full stop on that. I'm probably just going to scratch that. Should have come back in my face. Okay, enough of DAX. And look where we are. Back on trend. Back above trend on SPOOs. But below the P-Val here. So, Or is he going for seconds here? Nice. Nice. Yeah, that we were trading off the CVAH on Dow earlier. Now we come back down below that CVAL 3680s. Really nice little clean test there, and sold down again. So really nice up there as well. You got the one before?
Yeah.
What you were? Oh, you were on the the breakout on the low. The pullback.
I didn't ride it very far down, but I've made a decent little profit.
Nice.
So
Nice.
I think the first break below, I took a loss of 10 ticks, then I made 60 ticks, and then the second, when it came back up for a proper pullback, I took 2 10-tick losses and then made 30 ticks. So overall, I'm doing all right.
Nice.
I should have held the last one though. I should have held it, but I was just a bit. The price was really
moving around.
I just thought I'll take it while I'm still ahead, rather than risking it coming back and then ending up with being completely flat.
Sure, man. Sure. Nicely done.
But I missed the last one. The last one looks like it's the best test of all of them. Actually, it's right to the tick on the
680s
CVAL. Yeah, 6.8.
Yeah, it was juicy. It was nice. I actually went for a bit of spoos on this instead.
Yeah.
All right, here's Pal starting to talk. Let's go for it.
Not got any volume, Tim.
No volume?
Stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this
Spews
is
QP val test
the
there on the
overarching
pullback.
focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular. To achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2%. Before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
All right, we are lifting here. New highs on day across the board on equities. VIX down. Now be aware of the test on the VIX here on this trend.
Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also, do we get more labor supply?
All right, you're seeing high on day here, SPOO's yearly P-val. Just be aware of that. VIX set to drop a little further, I think.
Or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2%, because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the Sept. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for
Euro's hopping here
for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We have seen some supply side healing, but inflation has not really come down.
Okay, so relatively hawkish tones there, and we've made a nice pullback to some very, very big levels on the SPOOs. As Parwiz was saying, yearly p-val, nice area there, nice area to short off of, and we're making gains on those shorts right now. Quarterly -1 on the Dow, pull back there, and down we go. Trading back down around VWAP on the day now. So gold back up to test on the trend. Look at that, right on the trend.
Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering.
SPOO's offer 3920, 1,222 contracts, 174 behind it. 3920, 1,200 contracts offered.
Decision.
I think a number of things might
That
affect
guy's
decision.
spoofing,
The
I
main thing is
reckon.
we're not considering that decision, and I don't expect
There's
that we will
nothing
anytime
on the
soon.
bids like that. Nothing on the bids.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future, and indeed, Treasury rates moved up, so we should have had a lot of tightening taking effect. why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
All right, equities. All right, I'm just going to close this down here on. We're going to
world
leave.
of euphemisms that we live in here.
Just going to
with,
get this last one
below-trend
question.
growth and a modest increase in unemployment. I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So
it's a good question.
I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris, Rugaber.
Okay, that was a really, really good question from CNBC there. So we're gonna cut and leave Jerome behind to finish up his presser. So what we've seen here really across the board, as always prescribed, tons of volatility. But most important to note here really is that we didn't significantly breach these lows here. SPOOs picking up from this trend line and back up we go into the R1s. Quite the question to finish on. You know, how are you going to know if you're going too far? And the answer there is really he's like, I'm just going to keep raising these rates until we get the result that we're looking for. You know, so that's a pretty significant answer. Hawkish as you like. So yeah, I mean, you know, technically we are supported still in the trend here. So listen, I think these markets could wake up to higher markets tomorrow on equities. Euro found the floor here. Is the dollar going to behave itself? Sorry, that's young PJ. He's obviously lost his shirt in a position there. So listen, I will let you guys go and I'll see you tomorrow. All right, thanks for tuning in. Have a good one. Bye-bye.